Good morning, ladies and gentlemen, dear members of CFA Association Russia, and dear guests, because indeed we invited a few guests as usually. We start our first macro meeting over Zoom this year for members of CFA Russia early in February, on the second, not first month of the year. And we will talk about the possibility of a long-term bear market. And we invite, as usually, Andreas Bickel and Maxim Matveev, who will present both and lead today's event. So good morning, Maxim, CEO at Atera Capital. I may briefly present Maxim, introduce Maxim, and give the floor to you.
Yep, Vladimir, thank you for the introduction. Hello, everybody. This webinar will be slightly different than the previous ones. We will turn around the table a little bit and start with a few questions to the audience. Previously, we asked only questions to our esteemed presenter, but today let's start with 3 questions. And I'll ask Denise to put on screen the first one about the performance of the global equity markets this year. So in 2022, what do you think global equity return in US dollar terms will be? Think about, for example, MSCI all country world index. In dollar terms, the index comprises something like 9,000 stocks and covers pretty much global universe. Okay, yeah, let's close this questionnaire and turn to the next one about Russia. Denise, please put on screen the next one. About the returns on the Russian market. So the question is, what will be, in your view, equity return of the Russian market in US dollar terms in 2022? Again, think about something like MSCI Russia index or RTS index, something in dollar terms to be comparable to the previous results. Let's wait for a few more seconds. Excellent. And the final question, again, a broad one. Dennis, please put on screen the third question. What do you think will likely be the best performing asset class in 2022? And we've put here 5 categories, so please stick to them. We haven't put the category other. So bonds, equities, commodities, investment trusts, real estate, and cash. Just a few more seconds. Okay. Excellent. Let's review the results. Can we have on screen the results of the first questionnaire about the global equity markets? So it pretty much universal answer in the range of up to 10%, from 0 to 10%. Well, to put it into context, last year the return was 19%. And the annualized average was about 12%. So the audience expect below the annual average, but still not a negative result. Let's turn to the Russian results, because for example, last year Russia returned the same 19% return as the global equity market, though Admittedly, the standard deviation for the Russian market over the last 10 years was double that of the world index. And yeah, we see the audience is much more diverse in terms of results, but more, I think it's more, well, difficult to say on screen, but looks to be a bit more optimistic compared to the global results. And the final one about the distribution of assets. Yeah, commodities hands-on wins this race. Last year, it were real estate investment trusts on the first place, and equities and commodities about 27% return yeah, on the second place. Let's see whether whether the views of our audience will change after the presentation. And I pass the word to our presenter, Dr. Andreas Bickel, CIO of Blackfort Capital. He has more than 25 years of experience in asset management as the head of portfolio management at Goldman Sachs, Clarendon, and Rothschild Bank. Andreas, the floor is yours.
Thank you, Maxim, and welcome from my side. Let me share, as usual, my screen with you. But before we start, when I see the result of this survey, I'm a bit scared because I voted in all cases for the majority. So that already gives you a hint where I stand for. So equities below 10. I'm surprised, honestly, that you guys see the Russian markets like I do. So more than 10%. This is a huge bet, but it's not impossible. You know that it's cheap. And last but not least, if you were a regular listener to these webinars, you do know that besides equity, you have to diversify. And although the question of the seminar is, are we in a long-lasting bear market? I was almost putting it, are we at the beginning of a new commodity supercycle? Both questions are obviously a kind of suggestive. So therefore, the answer to both questions is most likely yes. If you look at the agenda, obviously I have to start with macro because macro lays the floor for the rest. Nevertheless, as always, I keep the real macro part of economists short while I look more to soft indicators, what it means for inflation, where do we stand? Is the Fed now finally ahead of the curve? What is the impact of the latest changement of the Fed narrative, in particular in January, which triggered an equity sell-off? Where shall you invest besides equities? Well, one answer you have given yourself, commodities. And as always, depending on time and interest, we might also cover FX, cryptos, and precious metal. With that, I thought also from my angle, let's do it slightly different than normal. I mean, it's one thing to tell you through the year that with quality bonds, you won't make much money. And if you make a positive return, like for instance, with US government bonds in Q4, if you take into the consideration inflation, it is probably crystal clear that you lose money. January was one of the worst since the 30s. You see here global equities, US equities around 5%. Eurozone has outperformed. This is not a surprise given that there's a lot of value stocks in there and the valuation is cheaper. You also see that emerging markets had in January and in Q4, not shown here, also through the whole year, a rough year. And the last thing obviously is in January, besides oil, besides some value stocks, some interest rate sensitivity stocks like financials, it was basically impossible to hide. So that is the past. The question is, what will the future bring? This is the only slide which is traditional. It was a bigger story on Bloomberg. Basically, it tells you France and Spain have in Q4 had a positive, strong, in brackets, strong growth disregarding the lockdowns and Omicron and Delta. And Germany, to me, to a lesser extent, a surprise, had a negative growth. All the soft indicators were through the whole year falling, and therefore this wasn't really a surprise. As we speak, because this is again history and it's priced in, it has no added value if you would earn money. So forward looking, the PMIs, the ZDW and the IFO of Germany, they all have strongly surprised over the last 6 to 8 weeks. If we try to see what markets tell you, you probably have read and heard a lot about the 10-year, 2-year yield spread. It's flattening, it keeps falling, it is all around. But recent research, which I've discussed in a previous CFA webinar, show that the forecasting power of the 10-year 3-month spread is much more accurate. And there you see a dichotomy between the two. Well, the shorter one is rising, so indicates that probably the growth might accelerate, while at the same time there is a flattening from the 2-year, 10-year, and also not shown here 2-year, 30-year. From that angle, if the published research is still valid in times when we have balance sheet manipulation by the Fed, i.e. bond purchasing program, if that forecasting power is still accurate, there is at least hope that we will see better forecasts than the latest IMF estimates. As you probably have seen, IMF has decreased globally growth forecast, but they still expect 4.4% growth globally for the world, which I would say is much above pre-COVID potential growth. So it's not that bad, although the news flow, the narrative in newspapers and research was definitely weaker figures, slower growth. Definitely slower growth, but with more than 4%, I would say still extremely healthy. I did yesterday some data mining and put you some key countries. So you see here the US manufacturing PMI at 57.6 and the ISM New Order almost at the same level. If you were to follow CNBC, Bloomberg, newspapers, etc., the narrative was like the figure came in much weaker, we are in a slowdown. That is not completely wrong. However, the forecast was lower, so the figure is actually a touch better. Second, I put here a green line, it's at 55. As a reminder, everything above 50 is growth, everything above 55 is acceleration, and everything above 60 is even quite exceptional. And from that angle, besides the US, Taiwan is shown, Germany is shown, German figures were up, and they are almost at 60. Eurozone figures aggregated were up almost at 62. So from that angle, if you believe in forecasting power of these soft indicators, the future is not so dark. There is more growth ahead of us, as most economists believe. And last but not least, the ISM price paid PMI, so the sub-indicator which tells you about the future outlook of inflation, was expected to be lower. However, it rose from 67 to 76, so a strong surge. The key surprise was markets ignored it. As you probably know, yesterday we are seeing the third day in a row where we have seen a sharp rise in equities in the US, including techs, and techs are interest rate sensitive. Why is that so? Among very few strategists and Fed watchers, I belong to the camp who believe the Fed has put every negative possible outcome for this year in their speech, in their communication. So we are talking now of 5 rate hikes. Today, the likelihood of 0.5% raise in March instead of only 25 pips has sharply risen. We talk of stopping the quantitative easing, the purchasing power program, and we even talk of actively running down the balance sheet of the Fed by selling bonds. I strongly believe all that during this year will not happen, and it will definitely not happen in the way it was communicated. And why so? And this obviously is now my educated guess, but my guess is because the Fed wanted to be ahead of the curve. They were behind the curve. They are criticized that they are behind the curve. They have misinterpreted the inflation, or they have deliberately let it run hot and did not do anything. I'm in the later camp, although they were probably surprised by the latest CPI figure. So here we turn to inflation. As you can see, strongly rising. That's the first glance. However, under the surface, Spain at 6%. True, but it was much higher before. Germany, a touch lower. US CPI at 7%. The expectation were 7.1. Eurozone, a very similar picture. So across the globe, we do see first signs of rolling over of inflation. Not shown here, the PCE deflator in America, so where you deflate or make real the nominal GDP in the US, is also falling and was lower than expectations. So we do see first signs on a high level of a slowdown of inflation. And in particular, it starts to decrease and not across the globe to increase. This slide is old and I have apologized the last 2 times, so I do it this time. So the quality is bad. It's taken from a blog. You see the guy underneath. What it tells you is that starting from March, and that's not far away, every month there will be a figure of more than 0.5% up to almost 1% falling out of the CPI statistic. Therefore, by a pure statistical base effect, you will see lower inflation data in Q2. And also the Fed keeps telling us we are fighting inflation. It's a top of the agenda. They are smart, so they do know even what they tell us now and they do in March will not have any effect until probably Q3, Q4 this year. But they might tell us in late Q2 or Q3, we told you so. Inflation is on the top and it's now decreasing. We are ahead of the curve, or we are taking care of it, which is probably not really the effect, or the effect is not because of what they tell us or will tell us. It's because of the statistic base effect. Having said that, you can re-engineer. If in H2 this year, we will see better figures, less inflation, what would you do if you were a Fed member? Well, maybe 4 hikes or 3 hikes. Maybe you postpone the start of the running down the balance sheet, etc., etc. So the Fed and the news flow out of the Fed is in a way that it can positively surprise after having crashed the market in January. You see here implied rate hikes, and the key message here, and this chart is roughly 10 days old. Today in the morning, I saw on Bloomberg News that the probability has even risen, that 50 bips in March is on the table. Well, obviously nobody knows what they will decide, but if I were them, I would do 50 bips in March and then tell, we wait for the figures for quite some time, so 3-4 months. To be seen what will happen, but the point is, the news flow can surprise in the near future. You also have probably heard about the news flow. The real rates or yields have risen. True, But if you look at this chart, US high yield bonds are still, after adjusting for inflation, deliver you a negative real return of roughly 1.77%. Not really a compelling argument to buy high risky bonds to get a negative real return. During the sell-off of equities, we have seen a slight tightening of spreads in the global high yield market. But if you look at the history, which includes March 2020, it is fair to say that we have still tight spreads. My guess is that if we have a decent growth, and with 4.4% IMF global growth forecast, they forecast more than 5% in the US, it is probably a fair assumption that spreads might hover at current level, and you get around 4% in high yields nominal term. However, 4% compared to 7% inflation is not really compelling. If that's going to happen, obviously it depends on the development of the economy, and it depends largely as well on the policy of global central banks, and that's one of the key risks for this year. Errors in the policy, too much tightening, or to let it run too hot. And last time when Fed Chair Powell has spoken, there was the announcement, what was prepared, markets went up, and then he was talking and talking and talking and preaching the same thing again. However, the market took it quite negative, that they might type faster, they might type more than what was in the written communication. I'm not so sure that this was the intention. I'm rather on the side that the communication was a bit unfortunate. This chart before didn't include the Chinese high yield spreads. Where you see the record level, this was published in Bloomberg. The only thing I did, I stored it and I can update it. And you see that after that, we had a strong surge in spreads. In the meantime, it has calmed down and spreads are lower. And if you were invested in Chinese bonds, in particular corporate bonds, you would see that some of the quality names which were hammered, so they went from 100 something to 50, they are now somewhere in the 70 area. So there was a certain recovery on the credit side. However, it is still extremely wide. If, and I believe that this will happen, the government in China decides to stimulate more, not just with monetary policy, what they did so far, and this could further develop, and this could have two positive unexpected effects. A, you would see a rally in high yielding corporates, and you would also see a rally in equities. The last bit I find extremely surprising is the light blue line on the left-hand side. The futures market for 10-year treasuries tells us still we see 2%, flat as a pancake, the Americans might say. And even if the dark blue line, Goldman were right that the Fed yield goes to, the treasury goes to 2.5 and the Fed yield to 2 in 2024, and then we might see a further rise. Even that were to happen, this isn't really a bad news for equities. It's priced in and the equities can cope with it. The forward-looking return is obviously expected to be lower if that were true. And here we are back to the beginning. You remember most of us have forecasted that the total return this year globally will be around 0 to 10%. And that's basically what you can conclude from that. On the right-hand side, on the other hand, you see that the futures market see roughly 2% by the end of 2024, or a touch higher. That would mean 8 hikes, maybe 10, but rather 8. And to go there, it is open if we see 5 this year, but if we were to see 5 hikes this year, then obviously you can only see 3 next year. And also that's the good news, is priced in. So therefore, the risk from the equities from this side, assuming that the language is not going to worsen and that across the globe, major central banks are not doing more in terms of hiking. We do know that at the moment, and it is priced in, and equities have corrected, and also bonds have corrected. Therefore, the forward-looking return is not extremely bullish, but rather positive. The key question, obviously, is, are we in a long-lasting bear market? Let me rephrase it. Are we still in a secular bull market? I remember that in June 2009, so ages ago, I turned bullish, and in the late 2011, I keep since then saying we are in a secular bull market, which will end in euphoria, which will end in a vertical line, parabolic rising equity markets. Have we seen that? The answer is obviously no. So therefore, my humble take is, to the first raised question, if we are in a long-lasting bear market, probably not. Probably we are in a correction within a bull market. So why do I believe that? First of all, if you look at this chart, you see bear markets go hand in hand with recessions. Based on all the soft indicators and what I've said, I don't see actually a recession risk for this year, and also for next year, the risk is extremely low. So supported from the macro side. If we look in two slides, and just two slides shortly, quickly at equities, I had to update this slide this morning after the third day in a row with a strong rising equity market. The story were to be, we are a touch below the 200-day average. This is the yellow line, and we will test the lows. In the meantime, as you can see, the narrative for the S&P 500 has changed. We have substantially taken out the resistance at the 200-day level, and we are approaching the 100-day average. So therefore, from a technical point, we need to see a retest of the lows we have seen last week. What I do not like on this chart, you see underneath the volume. So this sell down, this correction was done with very little volume. Not shown here is, at the same time, a lot of people bought a lot of puts. We are at all-time highs in open interest in puts. So people are invested and are protected at the same time. So the selling pressure is probably limited. If we turn to the NASDAQ, so interest rate sensitivity, this one on the index level, definitely corrected 15%. And underneath, more than 700 stocks in the broad index, and also more than 50% in the NASDAQ 100 stocks have lost more than 30% over the last months. So underneath, under the surface, be it the NASDAQ composite, be it the Russell 2000, a lot of stocks had a severe correction and a bear market. And for some cases, this lasts for more than 12 months already. Meanwhile, as we all know, at the beginning of January, the indices had even a new record level. Here, the same must be said. I'm not a chartist, but I know people look at it. And when Bloomberg does this story, you can see 200-day average. So if everybody looks at it, it must be considered. And we are now a touch below. However, as we speak, to yesterday's extremely good figures of Alphabet, once more, the fifth time in a row, they blew out all estimates. They do a stock split. Futures of the NASDAQs were up more than 1%. So probably in the opening, we are going to overpass this resistance. But correction is only over once we have seen a leg down, which closes above the low level we have seen during the sell-off last week. So from that angle, it looks much more promising than when I started this presentation on Friday. The picture is, at least from a technical angle, not clear to give a buy signal, but it looks definitely promising. But let's look at fundamentals, starting on the right-hand side. So you see figures are unchanged. EPS for 2022 for the S&P is bottom up. IBS 224 gives a PE ratio of a touch below 20. Goldman is a bit more bullish and sees 226, gives a PE ratio of around 19. Forward-looking 2023, this is a long way away, but nevertheless, bottom-up analysts are for the first time really bullish. They see 10% upside on an already higher figure, while Goldman is extremely cautious. But as we speak, we are on the left-hand side, we are in the process of getting Q4 results. Q4 results are mixed, or shall I say they are more in a normal camp, because we see around 77% plus minus who are beating, but we don't see figures like we have seen before. So therefore, the market is supported by expected EPS growth. And if we really see inflation averaging between 3 to 4%, most companies will increase prices, and at least nominal EPS might increase. Therefore, this 0 to 10% is not completely in the woods. It's really supported by an equal growth of earning. Still, you have the risk that the valuation changes due to higher rates. There can be shocks. I said in December, it can happen anytime that we see finally a correction of more than 10%. Guess what? We have seen it in January. Goldman has updated the chart, so the information is the same, but you see the re-evaluation. We are now a touch higher than what the graph implies. Nevertheless, you do see that the base for further rise is lower, and it's supported by a certain growth. But you can also see that from September 20 till the actual level, the growth was tremendous. It was year over year more than 45%. This is obviously going to end. Why we had a sell-off and what it might mean? Well, for a start, it was the Fed language. Second, it was the 10-year, 2-year spread. You remember first chart. When that happened in the past, normally you had a correction of 10 to 15% in the S&P. And guess what? It's exactly what we had. These guys, JP Morgan, conclude that the situation is similar to 83, 94, 2015, and unfortunately, I cannot see the 2000 something there. But the conclusion is this is a consolidation within the bull market. If we turn it around, this chart was done during the darkest time last week. So UBP made an analysis, given that this is one of the worst January since 1929, so since roughly 100 years, what happened afterwards during the rest of the year? And the answer is quite promising. In 3 times, obviously, we had a further decline. However, 2000, 9/11 afterwards, or before, recession, 1977, definitely recession, oil shock, and last but not least, 2008, global financial crisis, Lehman, and. So in these 3 occasions, markets went down. But look at the other occasions, it was either flat or up. In some cases, like 2009 and 16, even substantially up. So if the January is going down more than 5%, most of the time you see a strong rest of the year. This number crunching basically tells you a very similar story, but this time, if January is down, just down since the year 2000, what happened afterwards? With the exception of 2008, This shouldn't come with a big surprise. We are back to the Lehman case. In all other circumstances, markets were up for the whole year. Obviously, the guy who has presented it said this has to be taken with a grain of salt. It's a number crunching exercise, but it is not to be ruled out that starting from such a January, we can still positive year. And the stock exchange saying as the January goes, so goes the year. Is it listed in the last 20 years? In most cases, not true. Seasonality, last year I presented that a lot, and funny enough, it has quite well worked with a bit of a time shift. So we were sometimes a bit later doing what the seasonality chart in brackets forecasted. It's pure number crunching. It's voodoo, if you will. Nevertheless, look at January. First, you have a high, which we have seen in the first 2 trading days, and then it goes down, down, down. We have seen that too. However, we have seen an extreme worse January. So seasonality works in a way, but not completely. February is always a difficult month, but we might see a spike back. We are already in that. Maybe we are early, and then followed by another leg down. And if I'm continuing to read in my gloss ball, I might add, and then we hopefully will test the low and not break through. If that's going to happen, we have to see. In March, as we all know, there will be the Fed. But from that angle, it is as well quite possible that after such a price pattern, we see more prices rising. Risks. I mean, I could continue with positive narrative, but let's try to concentrate on risk. And the real major risks are central bank balance sheets run down and the stop of QE. As you can see, since 2009, we are in this unprecedented period where, starting from the US, but spreading in most major countries, we have seen a substantial widening of the central bank. We have seen a substantial money base increase, and until recently, we haven't seen inflation. I have talked about it before. The reason for that is very simple. While this balance sheet is expanding, at the same time, private and corporate, so private companies, have repaired their balance sheet. It was basically impossible, if you believe in this theory, that we see inflation. And the guy who is the father of this theory, also presented last year, said the only way out is fiscal stimulus. And guess what? Since we have fiscal stimulus, we have inflation. Guess what? Since we have fiscal stimulus, Russell Napier, which I have quoted the last time, has turned from a bear, from an inflation pessimist or deflationist, to a person who expects inflation, who expects financial repression, and expects inflation to stay here higher, at higher level, and not to be transitory. For all those of you who listen to this, this shouldn't come with a surprise to you. Therefore, my take is still the same. Inflation is sticky and is here to stay. However, I strongly believe if there is not a substantial error on the central bank side, it will stay at higher levels than before, so 3+%. And government bond yield will most likely not go to that level. So you have real negative yields. And therefore, you solve over a long time, and with a long time, I mean more than 10 years, you solve the debt to GDP problem in real term, aka financial repression. And I have seen recently in various ways, without using the word financial repression, this narrative, even in newspapers. So it is quite likely that it's going to happen. And therefore, the key risk is, because in such an environment, equity rise, the key risk is how fast will we run down the balance sheet. My guess is still what I said at the beginning, the Fed has deliberately over-communicated to be ahead of the curve and to surprise in the future. The other risk is this one. Since this statistic runs, we are now seeing the highest level or allocation of equity in households. That will mean revert. The question is when. The good news is, look at the debt level, has decreased. If we look at this statistic, I'm not using the term this time is different, but it is to a certain degree a conundrum. There is a rising cash pile. Meanwhile, you see substantial inflows in equities and you see no outflows, even slight inflows in bonds. This money needs to be deployed, especially if I'm right and other people's I follow that inflation will be sticky above 3%. And where can you invest besides equities? The next question. Last but not least, this for equities is a risk that forward-looking we will see the beat and the mist in US earnings and globally to surprise to the negative. And the news flow was actually quite negative over the last days. But if I look at this, I could turn it around. I mean, still more than 75% of all companies have beaten their estimates. The miss is at almost 20%, but that's a kind of normal. Before COVID, we were rather seeing somewhere a figure below 60 who beat and more than 20 who missed. And this is for me rather neutral, although the news flat or even going down. So also from that angle, there is support. And now, I mean, you should invest into equities. And you see this chart is the same like last time, but I didn't find a better one. So if we were to see 0 to 5% inflation, the best performing asset class is equity, followed by gold, real estate, and commodities. I would say the forward-looking return for equity is depressed due to extreme high valuation, but they still should deliver a decent return. REITs will on one hand profit from rising rental rates due to inflation, but obviously they will also be hurt due to rising yields. But nevertheless, I would expect them to perform like real assets. Gold has a similar problem. We had that several times in the past, stronger dollar, rising yields, although at the same time negative real yields, plus the outflow of mutual funds and ETFs have so far depressed. If you are a technical analyst and follow gold from that angle, they keep telling us we are running into a triangle and there will be a breakout, but the breakout can be to the up or to the downside. So this time I thought, given that I just got recently this interesting presentation from a metal minings fund, I tried to do a bit more on commodities and mining. So what you can see is that in both in the mining index and in the gold index, that's this blue circle, you see the EV to EBITDA is one of the lowest compared to the broad index. You see that the operating margin is much higher compared to the broad equity index. And last but not least, they trade substantially below their all-time high. And on the left-hand side, you see that at the moment, the main mining component is coal, followed by copper and some minor things. Forward-looking due to the green revolution, this will shift completely. Coal will disappear or at least get insignificant, and all the other metals you need for car production, which you see here in the battery, wiring, chassis, frame, etc. There are a lot of metals needed, and most of them are different to a traditional car. Therefore, are we at the beginning of a commodity supercycle? I would say yes. Here you see the performance commodities to S&P, definitely strongly underperformance since the global financial crisis. I would expect that commodities outperform. Unfortunately, I must say this seems to be consensus, because you remember at the beginning, most of us, 71%, expect that commodities will beat equities. Having said that, I do believe that global equities will outperform the US, but I must add the US will deliver a positive return. If not, you can delete this statement. If the US is in a severe bear market, then global equities, with rare exception obviously, but on average will not perform well. The Russell 2000 should outperform for the simple reason that the small caps have the lowest valuation since 20 years. This we had already. So if you believe in green energy, you can on one hand go to these various metals, and if you are not ESG compliant, you can consider uranium, which you can buy in a physical trust. I said that last time, so I will be brief, but 86% of the global electricity production is done through oil, gas, and coal. 4% with nuclear power station, that gives you around 10% in alternative. So all this news flow that the alternative will save the world. We had here recently a discussion that everybody who owns a house has to put the solar panels on the top. This will not solve the problem. We need other sources. And I can understand that nuclear power stations are not considered green because of the waste. But if carbon emission is a key element, then this is a green energy. But if you look at the chart, this is a performance chart. We had a strong year last year, and we had a strong correction. It is extremely volatile, but you could consider such an allocation. Copper, you saw the problem of the copper is needed all around in the green revolution, and forward looking, copper has this problem. The projected mine production doesn't match the supply. Therefore, Goldman's forecast that copper will go to 15,000 from below 9,000 in the next 4 years, actually 3 years, 25, is not so unrealistic. Brent or oil in general, I mean, this morning I saw on CNBC that the OPEC is expected to increase the supply at its next meeting. This is not completely new, but at the last meeting, they only increased it slightly, with the effect that you saw or we have seen this strong rise. I would expect this to mean revert. However, at the same time, midterm, probably the trend continues. You haven't seen, but this year to date, one of the best performing sectors was energy, traditional energy stocks. Gold we had, I do hope that it holds. A and B, midterm, it really rises above 1850. And there are some reasons for it. The dollar is strong, okay, headwind, high yield is here, but we have inflation and we have still negative real yields, and we have probably demand. With that, let me come to the conclusion. So I believe we are not in a long-lasting bear market. We had macro slowdown in Q4, but recent figures, especially in Germany, but also yesterday's PMI selectively across the globe, do show some signs of improvements. The biggest risk is that the central banks tighten too much. Inflation is here and sticky, and it will transfer money from savers, private people, to the state. We have still problem balance sheet recession in certain cases. This is fading as we speak. A lot of companies announce share buybacks, and that you can only do if you have a healthy balance sheet. So that effect is going to fade. At the same time, We have fiscal stimulus, in particular in the Eurozone. There is another package in the pipeline. So where shall you invest? Corporate bonds give you a certain positive yield. However, it will be very tricky this year. Asian corporates have a tremendous yield. However, they have also a lot of pitfalls. So this is really, really for people who are deeply into the subject. Don't invest in cash. Don't invest in government bonds unless you must to, and or you use it as insurance for crashing equity markets. Investment grade bonds are expected to do poorly. Where shall you invest? Well, first of all, I expect a certain roller coaster till we have finally adapted to the new global central bank regimes. If that is going to happen and over Europe, emerging markets do look more attractive than the US. Asia has to catch up. In particular, China might surprise this year. They have announced stimulus and there might be more. Small mid-caps are extremely cheap in the US, but it's also true globally. I still believe global microchip producer look interesting. Obviously, after what I've said, you should consider commodities, in particular mining. The tactical trade I mentioned the last 2 times is still on, but we have probably seen most of it. Gold is still the tricky bit. I would hold it physically as an insurance policy and as a saving assets for inflation. I would hope, but not speculate, that we will see higher gold prices, but inflation adjusted over midterm, it should serve you like it did over the last 200-300 years. It should preserve your purchasing power. REITs or real estates are on one hand hit by inflation, but on the other hand, they have the chance to adapt rents due to rising inflation. We do know that markets are expensive and you should buy when the cannons are firing. This was last week, has not changed. At the moment, we have seen partially the tide goes out, and who swims without swimming suit, or he has written naked. It is painful in some sectors, but it has also other sectors like, for instance, financials or energy, which are year-to-date sharply up. If you want to have regular updates, do not hesitate to follow us on Telegram. And with that, I hand it over to Maxime for questions. Thanks a lot for your attention.
Andreas, thanks a lot. I think, your views reinforced the initial outcome of our today's questionnaires, and commodities is really a place to go. We have a question in the chart about the interplay between stock market and gold. Alexander is asking that according to his...
I can ask it by myself, if you will. Yeah, thanks.
Sure. Yeah, please go ahead. Yeah, welcome.
So many banks we spoke with, they noted that for last couple of months, so retail was selling when ETFs they were buying. In fourth quarter, maybe at the beginning of 2022 as well, we saw pretty much opposite picture in gold. So there was demand fell from ETFs and a huge demand boost from retail. So my conclusion is after probably October's scary inflation print, retail turned from equities to gold. Do you think that in the case we see some reversion from that side of Fed, some more, probably more dovish narrative? Do you think that we can see a reversal of this picture from retail? So do you think there's they would go from gold, from less risky asset to equities again? Thank you.
Well, first of all, I've seen the same view like or fund flow like you said. So retail was going into ETFs, and yeah, last year they were going out of ETF. The narrative goes that they went to Bitcoin and other crypto assets, question mark. It is really hard to foresee what retail does. If we were to see a strong melt up in equities, obviously I would expect money flowing out of gold, safe assets into equities. I'm not expecting that right now. So for the next 2 to 4 or 5 months, I do not expect a strong rise in equities. I might be wrong because CTAs are extremely short equities and they had probably 3 very painful days and they might have covered some of their shorts. But I would, at least for the shorter term, not expect that to happen.
Okay, so, thank you.
Or will not be hurt by outflow if my assessment is right. Obviously, it can be wrong.
Yeah, thank you. Yeah, if there are any other questions from the audience, just please just raise your hand, and we'll invite you to speak. One of the questions that I have is that about the American market, which have very high concentration in tech stocks. I think like something like 25% of the market cap or something like that in the top 5 stocks. Do you think this is a particular risk in the current situation, or otherwise it's more reassuring that these are profitable companies with cash on balance in most cases, so they're more resilient?
I mean, short term, if you look at Apple or Alphabet's figures, and if I'm not wrong, also Microsoft, they were extremely strong. They're extremely cash flow positive. So short term, probably this concentration is going to last. However, if you look back in history and what was 10 years ago, 20, 30, etc., goes the top 10 stocks, I cannot tell you what will be the top 10 in 10 years' time, but I would strongly bet out of this, I would say 10 stocks, 8 will be not the same. Doesn't really answer your question, I know, but they are so large that a lot can catch up, and some might lose their edge. There might be new competition, there might be new technology. That doesn't mean that they are still large and still profitable, but maybe something else will be in the top 5.
Yeah, absolutely. Yeah, if you've seen the dynamics of the change in the top, in the top 10 stocks, yeah, they were changing every decade. That's for sure.
We have seen yesterday the Alphabet figures, the reaction. Short term, this is extremely supported. And I mean, the surprising bit was everybody was expecting due to the loosening Delta Corona policy, we will see less internet use, less publicity. By the contrary, Google publicity income all-time high, YouTube one of the highest on record, maybe even all-time high. So internet or the usage or what we do with our spare time is probably going to stay, because you can access all these things through your smartphone. You don't need to be at home. And this was a surprise for a lot of analysts. And I'm not an analyst for this stock, but I take notice that this trend to more consume online is here and is here to last.
Yeah, and the case of our online webinar is another confirmation for this. I think we don't have any further questions from the audience. So Andreas, thanks a lot for the presentation. Thank you for the participants for tuning in, and let's meet in 1-2 months' time. Thanks a lot, everybody.
I mean, have a good time until next time.
Until next time. Yeah.
Thank you.